The market isn't just reacting to what the Fed did, it's reacting to what the Fed is thinking. And that's where most investors get it wrong. Every time the Federal Reserve makes a policy decision, headlines explode. Stocks swing wildly, bond yields spike or drop, and social media fills with hot takes. But behind all that noise, there's a deeper strategy unfolding, one that directly impacts your portfolio, your mortgage, your savings, and the future direction of the U.S. economy. The Federal Reserve recently delivered its latest policy decision, and on the surface, it looked straightforward. Interest rates were adjusted or held steady in line with expectations. But markets don't move based only on the decision itself. They move based on tone, projections, and what investors believe will happen next. The real action isn't in the rate hike or pause, it's in the message. Right now, the Fed is fighting a very specific battle: inflation. After years of ultra-low interest rates and aggressive stimulus, inflation surged to levels not seen in decades. In response, the Fed began one of the most aggressive tightening cycles in modern history. The goal is simple in theory: cool down the economy enough to bring inflation back under control. But in practice, it's a high-risk balancing act. When the Fed raises interest rates, borrowing becomes more expensive. That affects everything: mortgages, car loans, business expansion, credit cards. As money becomes more expensive, spending slows down. When spending slows, demand cools. And when demand cools, inflation begins to fall. That's the textbook explanation. But here's the truth: the market doesn't wait for results. The stock market, including major indexes like the S&P 500 and the NASDAQ Composite, moves based on expectations of the future. Investors are constantly asking one question: what happens 6 months from now? Not today. If the Fed signals that rates will stay higher for longer, growth stocks tend to fall because future earnings become less valuable in a high-rate environment. Bond yields often rise because investors demand higher returns. The U.S. dollar strengthens as global capital flows toward higher-yielding assets. Liquidity tightens across the system. And when liquidity tightens, risk assets feel pressure. But here's where things get more interesting. The Fed isn't just trying to control inflation directly, it's trying to control financial conditions. Financial conditions include stock prices, bond yields, credit spreads, and overall access to capital. If markets rally too aggressively, financial conditions actually loosen. That creates a wealth effect. When people see their portfolios rising, they feel richer. When they feel richer, they spend more. And more spending can reignite inflation. So sometimes, when markets celebrate too quickly, the Fed subtly pushes back with tougher language. Not because they want to crash the market, but because they don't want conditions easing prematurely. This is the psychological chess game happening between policymakers and Wall Street. Communication has become one of the Fed's most powerful tools. A single word change in a policy statement can move billions of dollars. A slight shift in tone during a press conference can send yields surging or stocks tumbling. Large institutions parse every sentence, every projection, every nuance. Retail investors often react emotionally, but institutional capital reacts strategically. Right now, the Fed is navigating a complicated landscape. Inflation has cooled from its peak, but it hasn't fully returned to target. The labor market remains relatively strong, consumer spending has been resilient, and certain sectors of the economy continue to show momentum. However, there are signs of stress beneath the surface. Higher interest rates eventually expose weaknesses: over-leveraged companies, fragile commercial real estate markets, and consumers stretched thin by rising credit card balances. History shows that aggressive tightening cycles often reveal cracks somewhere in the system. Liquidity doesn't disappear all at once. It slowly drains until something breaks. That's why markets remain volatile. Investors are constantly scanning for signs of stress in regional banks, in corporate debt markets, in housing data. At the same time, the Fed must protect its credibility. If it cuts rates too early and inflation resurges, it risks losing control of long-term expectations. If it keeps rates elevated for too long, it risks pushing the economy into recession. This is the tightrope. And the market is trying to anticipate Which risk will materialize first? Here's the deeper truth behind the Fed's latest moves. This isn't about short-term market performance. It's about long-term economic stability. The Fed would rather tolerate market volatility than allow inflation to become entrenched. Stable prices are the foundation of a healthy economy. Without them, growth becomes unpredictable, wages lose purchasing power, and financial planning becomes chaotic. For investors, this environment demands discipline. High interest rates change valuation models. They reward companies with strong cash flows and punish those dependent on cheap financing. They make bonds more attractive relative to equities. They shift capital allocation decisions across the entire financial system. Smart investors focus less on guessing the exact timing of the next rate cut and more on understanding the direction of financial conditions. They watch bond yields closely. They monitor credit spreads. They analyze earnings strength rather than chasing speculative momentum. They maintain liquidity so they can act when opportunities arise, because eventually, every tightening cycle ends. When the Fed pivots, whether due to falling inflation or economic slowdown, markets tend to move quickly. But trying to perfectly time that pivot is nearly impossible. Preparation matters more than prediction. So the next time you see the market surge or tumble after a Fed meeting, remember this: it's not just about the rate decision. It's about expectations, psychology, liquidity, and credibility. The Fed isn't trying to crush the market. It's trying to engineer a controlled slowdown without triggering a severe recession. That's incredibly difficult, and that's why volatility remains elevated. The truth behind the Fed's latest market moves is that we are in a transitional phase. The era of easy money is over. Capital is no longer free. Risk must be priced correctly again. And in that adjustment process, there will be winners and losers. For long-term investors, this period is not something to fear. It's something to understand. Because when you understand the forces driving the market, you stop reacting emotionally and start positioning strategically. And in this cycle, strategy will matter more than ever.